Economic indicators play a crucial role in apartment investing by providing insights into market performance, rental demand, and investment opportunities. Monitoring metrics like GDP growth, employment rates, inflation, and interest rates helps investors assess market conditions and make informed decisions. Changes in economic conditions directly impact rental affordability, property values, and overall investment returns, making economic analysis an essential part of investment strategy. GDP growth reflects the overall health of the economy. Strong GDP growth often indicates rising income levels and increased rental demand, while declining GDP suggests economic challenges that may impact tenant affordability. Employment rates. High employment rates and job growth signal a healthy labor market, increasing tenant demand in areas with strong job prospects. Conversely, high unemployment rates can reduce demand and affordability. Rising inflation increases costs for tenants and property owners. It may lead to rent increases to offset higher expenses, but can also strain tenant affordability. Interest rates. Changes in interest rates affect financing costs for property acquisitions, refinancing, and development. Lower rates typically encourage investment, while higher rates may suppress activity. Rental demand, economic growth, and job creation attract tenants to an area, increasing demand and stabilizing occupancy rates. Conversely, economic downturns can lead to reduced demand and higher vacancy rates. Property values. Strong economic conditions typically drive appreciation, while weak conditions may stagnate or reduce property values. Investment returns. Economic stability supports consistent rental income and lower risks, while volatility may affect cash flow, operating costs, and returns. Tenant affordability. Economic challenges such as rising unemployment or stagnant wages may strain tenant affordability, impacting rent collections and rental rates. Shifts in demand. Changes in employment patterns such as remote work trends can affect where tenants choose to live, influencing demand in urban versus suburban areas. Financing environment. Interest rate fluctuations impact investor costs for debt financing, influencing decisions on acquisitions, refinancing, and development. Example, an area with strong job growth and low unemployment rates is likely to see stable rental demand and property appreciation, presenting a favorable investment opportunity. Monitor key economic indicators for the target market, job growth and unemployment rates. Analyze local job creation data and industry trends to assess economic stability and tenant demand. Median income levels. Review changes in income levels to understand tenant affordability and potential rental rate adjustments. Population growth and migration. Study population trends to identify areas experiencing growth, which supports long-term rental demand. Interest rate trends. Track changes in interest rates to assess the cost of financing and its impact on property valuation and acquisition feasibility. Government sources. Use data from the U.S. Bureau of Labor Statistics for employment and income trends and the U.S. Census Bureau for population growth data. Local economic development agencies engage with local organizations to access regional reports on economic development and industry growth. Market analytics platforms, tools like CoStar and Zillow provide insights into local market conditions, including vacancy rates, rental trends, and demographic shifts. Evaluate rental demand. Use job growth and income trends to predict shifts in tenant demand. Areas with growing industries and low unemployment typically attract more renters. Gauge affordability. Compare median income to average rental rates to assess whether tenants can afford rental units without excessive strain. Consider market risk. In areas with economic uncertainty or high unemployment, consider potential risks such as increased vacancies or delayed rent payments. Focus on growth markets. Target areas with sustained job growth, population increases, and a diversified economy for stable and appreciating investments. Adapt to economic cycles. During economic downturns, consider value-add investments or repositioning properties to meet evolving tenant needs. Leverage low interest rates. Take advantage of favorable interest rate environments for acquisitions or refinancing, locking in lower costs to enhance returns. An investor evaluating a market for potential acquisitions observes the following. Job growth. A 5% annual increase in jobs, driven by expansion in the tech and healthcare industries. Unemployment rate. A low unemployment rate of 3.5%, indicating strong tenant demand. Median income, rising income levels, outpacing national averages, suggesting tenants can afford higher rents. Based on this data, the investor anticipates strong rental demand, supporting stable occupancy and potential rent growth. With rising incomes and low unemployment, the market is deemed favorable for a long-term hold strategy or value-add improvements. Tracking economic indicators such as GDP growth, employment rates, inflation, and interest rates provides essential insights into market conditions for apartment investing. By analyzing how these metrics influence rental demand, tenant affordability, and investment returns, small apartment investors can make informed decisions and adapt to changing economic conditions. Leveraging economic data helps investors identify high-growth areas, mitigate risks, and optimize strategies to maximize returns in a dynamic market environment.